Welcome to the Ag Commodity Corner Plus.
Hey, everybody.
It's June 27th, 2025. Our topic or our title today is Funds Ditch Ag Commodities, Chase Stocks Amid an End to the Middle East War and Trade Deal. There's some hope about some trade deal buzz. We'll get into everything, but let's start off with the quick weekly summary. And you can see from this chart that it was an ugly week. You can actually tell that the stocks are trading high while ag commodities were trading lower. So that's what we're talking about when we say that the funds were chasing stocks, yet ignoring the ag commodities. They do not want to own corn. They do not want to own beans. This goes all the way back to the last couple of years. We're back to that same pattern. At the beginning of the year, we had that gift from USDA, and we hit a roadblock. We hit a hiccup because of U.S. tariffs. Everybody was fearful of that, and the reciprocal tariffs and all these wars. But we've been able to climb that wall of worry, and we've talked about this in past podcasts. And then you can see that crude fell dramatically. We'll talk about that as well. And the U.S. dollar hit new contract lows. So let's start off with this 12-day war, Abhinash.
Well, like you said, Mo, a lot of things to cover in today's weekly podcast. Let's start with the situation in the Middle East. The last couple of weeks were, we had news on the war that was going on, but following that proxy ceasefire sort of situation, according to media reports, we've got European officials claiming that the early intelligence suggests that Iran's uranium enrichment program or otherwise their uranium facilities are largely intact. Trump, though, today came out saying that if they continue with their enrichment process, he would order additional strikes.
He also said that he would lift some sanctions off Iran as well, and that's what they've been looking for. But from this image on this podcast, okay, so there's some destruction, obliteration of maybe the top of that. But did that bomb, that 30-pound bomb, actually go 200, 300 feet? I doubt it. So I don't know. We'll see. Look, many experts think that the end to this war's not going to come, that Iran's not going to negotiate with U.S. Trump. He was supposed to meet with them next week, but I'm not sure that's on anymore. So, you can see from the chart on crude here that the ceiling's around 78, the support's 65. We're back to that support. We eliminated or removed that war risk premium. It was around that 10 to 13 bucks. So we're not surprised. But Abhinash, isn't there some breaking news here today?
Oh yeah, there's OPEC Plus, which is considering another outsized production increase. So there's extra weight on these crude oil futures.
Now remember, the Saudis have 2 million barrels a day of spare capacity, and before this war started, if you remember, when we got down to this low here in this 55 range, it was the Saudis that were increasing their production, and they've decided to keep doing that. And if they want to keep fighting that war, that market share war with the U.S., you're probably going to revisit those lows sometime this fall. So we're going to wait till the summer driving season before we do anything more with crude oil. We hope that this comes to an end. And once we get past the summer driving season, we should be able to retest that low at 55 or even go lower.
Let's quickly look at the U.S. cropping weather more. No real concern for the eastern corn belt for the second half of July. In the next 7 days, it's expected to be warmer and wetter. It is expected to be 40 to 50% wetter near term. But the 18 to 14-day forecast is calling for hotter and drier weather with up to 50% less precipitation than normally forecasted.
The production's getting bigger, the yields are getting bigger. I'm sorry, folks, but that drought that everybody was forecasting, including Snodgrass at the beginning of this year, where is it? I just don't see it, unfortunately. We haven't seen it all year round. Remember, I don't think the USDA is going to do anything in the July crop report once we get past the market moving reports on Monday, which we'll get to here in a second. I think they'll kick the can down the road, but in last year in the August report, the U.S. corn yield went from 181, which is currently where it is today, at 183.1, up 2.1, and the soybean yield went up by 1.2 to 53.2 versus a 52, and right now we're at 52.5, which would be a record high.
The chart here shows all three of the main grains with the weaker, the market reacting to lower weather risk premiums, or in fact, the weather risk premiums almost evaporating. You've got July corn, which is down 11 cents this week. You've got July soybeans down 40 cents, and July Chicago wheat down 43 cents.
Yeah, this is on schedule. It's a seasonal thing. We're not surprised, and I doubt whether the reports on Monday are going to move markets a lot, but we'll get into that here. It was just an ugly week, and I think part of it was also the month-end selling, end of quarter, end of month could have played a role. We're getting a little bit of a bounce here because of trade deal hopes, but I think the market's getting ahead of themselves again, especially with that July 9th reciprocal deadline near.
Well, let's circle back to those trade deals. We haven't been chatting much about the trade deal situation, mostly owing to the holidays some of these countries received from the trade wars. The White House signed a rare earth deal with China in exchange for unspecified relief, and there are supposedly 10 trade deals ready to be signed ahead of the July 9th reciprocal tariff deadline. Nonetheless, elsewhere, Trump supposedly ended all U.S. trade talks with Canada over digital services tax. Trump on social media said termination to the Canada trade talk comes after Canada announced American technology will be hit with digital services tax, and he added that this is a blatant and direct attack on the U.S.
They were supposed to sign a deal by the end of July. This is crazy. Again, we're flip-flopping along the way. What do you think? Will we get any deals by July 9th? And they're saying that the July 9th deadline's not critical, but I think the markets are going to get disappointed again.
Mo, I think you used the right word there. It's that flip-flop. It's expected, trade deal versus what really is happening. Like you said, I don't think a lot is going to be signed by the end of the year.
I mean, EU's talking about doing a deal. They're saying they're close with India. But with the ags, unless you get details, unless you get purchase agreements where you see China doing a goodwill gesture, buying 2 million metric tons of beans, nobody cares. Well, guys, don't forget, join our club. If you're looking for one-stop shopping where you want to manage all your risk from diesel fuel to fertilizer to basis and futures, we can teach you how to do it all. We tend to focus simply on the cash opportunity, but if you want to learn how to do all the other fancy stuff and capture carries with storage and all that fun stuff, we can do that for you. So try the program. It's free. You got nothing to lose. Remember, we got the app. This week we were talking about the technical sell signal in soybean futures. That may be a false signal depending on what happens with Monday. And then, of course, we always provide for our clients a game plan ahead of the market moving USDA reports. We do that once a month. And we have our live webinar on Monday for those reports. So you can check in. Once you sign up to our program, you can sign up to the webinar. You can look at it's a quick 15, 20-minute PowerPoint presentation. You can ask questions along the way as well. So check it out.
Monday, like you said, Mo, we have the market moving. An annual June acreage report from the USDA should be out by noon Eastern time. And the trade estimates prior to the report are pointing to almost unchanged estimates for the corn and wheat acreage in the U.S. Soybeans trade is expecting it to be slightly higher versus March. The bigger deal, though, as far as Monday is concerned, could be the stocks report, in which we could get bigger stocks from corn, mostly owing to possibly higher yields for the old crop. We could add as much as 100 to 200 million bushels more.
So just to go back to the acreage report, when the trade has no idea what's going to happen on Monday, you get room for big surprises. And guess what? It's a holiday week, and I don't know if you're celebrating with your own fireworks, but maybe we get fireworks on Monday. It can happen. There's been years where beans can move 70, 80 cents. I doubt that's going to happen Monday, but that's always a possibility. And you can see the big ranges. So this is, this is corn here, and then you can see the big wide range here. So we'll have to wait and see. Because of that fast planting pace, earlier than last year, some are suggesting we've added more acres. We're around that 96 million acres. It could come even in higher, especially in that north. I think we've taken away from beans, so that bean acreage number 83.7 come in lower, and that's the friendly number. So I think the acreage numbers come in bearish for corn. But again, when you do the analysis on the corn balance sheet, you're basically headed back to 2 billion bushels from 1.4 or 1.3 for whole crops. So does it move the needle much? No, but you're going to add some bushels. You add that South America record large corn crop, and the market's not concerned or nervous or any of that. So if you go to that acreage report, as Abhinesh was saying, the trade talk is talking about another 100 to 200 million bushels. It could show up in this report. It could actually show up in September. The cash market's telling us that there's more bushels than the market's suggesting. So with everybody confused about the spreads and the old crop dropping 90 cents from the highs, maybe this report will give us some answers. We don't know. We'll have to find out on Monday. But again, if we find 100 or 200 million more bushels, that's just bearish corn again.
Switching more from the grain markets to the stocks market, and this is a chart of the NASDAQ index. Thanks to AI trade and the big one, NVIDIA, which has climbed to record highs. You've got the NASDAQ, which is a tech stock index, climbing to record highs. It is up by about 37% since the early April. That was when the trade wars were raging. And from that low, we are up by about 37%.
We're hearing that AI demand is through the roof. Remember, there's a difference between training and inference. Training is all those large language models like ChatGPT. We're hearing that more and more companies are using AI on a daily basis. I know we are with these podcasts, creating these podcasts. Salesforce, which is a company, says that they use 30 to 40% of daily work is being created by AI. So this is incredible. So the inference is when you start using, once you've trained a model and you start using that model to help you become more efficient, productive, supposedly that inference is through the roof. And so there's two companies that will benefit the most, NVIDIA and AMD, Advanced Micro Devices. But the Mag 7 look really strong. We had a negative GDP print of minus 0.5 for the first quarter in the U.S. So do we actually get into a recession for Q2? If Q2 earnings, because of Mag 7, surprise to the upside, you may avoid a recession. So because Q1 earnings were actually better than expected, up 13% versus expectations for 9.4. And so this chart just shows you that on average, right about here, you 15 out of 16 years, when May and June are up, which is rare, by the end of the year, 15 out of 16 years, the market can gain another almost 9 to 10%. So let's see what happens moving forward.
Also, more this week we had the quarterly USDA Hogs and Pigs report, which is again could have been market moving for livestock and specifically the lean hogs futures market. So the Hogs and Pigs report turned out to be largely neutral, possibly slightly bearish. The all hogs inventory was almost as expected. The three standout numbers were the kept for breeding, or rather kept for marketing, numbers, which came in slightly bigger than was expected. It's the largest in the last 5 years. You've got higher than expected inventory in the 120 to 179 market hogs category. And for 4 straight quarters now, the average number of pigs per litter is setting a new record.
Yeah, so I think this report will get faded. It was a little bit bearish versus expectations. And of course, USDA revised the last quarter up instead of down because of disease. Disease never shows up in these reports. So, it'll take a couple days to fade it. The market will go back to trading the fundamentals, strong cash, strong cutout. So we'll see. Nothing too bearish that I would expect this market to start to turn much, much lower. So, but it wasn't a bullish report, but I don't think anybody was expecting a bullish report.
Looking at the US dollar index, it's crept down to new lows. This is the dollar index chart. You've got the dollar index, which is the lowest since late Feb 2022, and the index hit 96.605. And the reason is because of global de-dollarization. As that continues, basically you've got countries which are selling US assets and the US dollar. A lot to do with the trade war situation, and the US GDP, which was finalized for Q1, came in at a negative 0.5% versus Q4 of last year, which was a positive 2.4%. The big question, Mo, is do we avoid a recession in Q2?
We already talked about that. I think we do. Look, the global economy remains resilient. We're breaking below a long-term support at 98. You can see a bunch of tops here. But remember, when the U.S. dollar falls, yes, long-term positive ag export demand. But guess what? It's also positive for Mag 7. Why? Because 60% of their earnings come from outside of the United States. So next target, 90. We're in a bear market on the U.S. dollar. Alrighty, let's move on to soy meal futures. This is positive for livestock producers.
Well, the soy meal futures market has, as you guys can see there, that's a long-term downward sloping downtrend there. Competition from South American exports, and also the fact that the latest RVO mandate, which has not become a law yet, could lead to bigger soy meal supplies. And there isn't enough demand to chew through all of that. And due to all of that, you've got a weak soy meal market, which, like you said, Mo, is great news for livestock feeding.
Higher hogs, lower meal, and lower corn. That's a blessing. We've been forecasting lower meal prices for months, and I think we are going lower.
The other report, like we spoke about this week, was big for quite a few of those updates from the governmental agencies. This one's from Stats Canada, and as far as June acreage is concerned, which was out today, you've got Stats Canada reducing the canola acreage estimates versus what they reported in March and also versus last year, whereas for the all wheat, it is slightly higher year on year.
Yeah, so this report was slightly friendly versus expectations. A little bit lower canola, a little bit lower spring wheat compared to the March intentions. Lower canola means lower production, potentially lower yields. Who knows? Depends on the month of July, how hot and dry it gets. But that means lower ending stocks. So I know the market sold off a little bit here today, but that could have been, again, end of quarter, end of month fund end selling.
And finally, as we normally do, to look at the weekly CFTC, and this is as of June 17th, we had selling in corn, whereas the spec funds bought into soybeans, bought into soy oil, all the three wheats, and the star of the show continued to be canola at record highs, almost 140,000 contracts in canola. In corn, we are about 185,000 net short. In soybeans, we're almost 60,000 net long, and Chicago wheat over 81,000 net short.
In real time, after this week's ugly week, the funds are record short. Well, not record short, but they've added to that short position. They've probably are short beans now. They've added back some of their short positions in wheat, and they've taken some length off of that canola. So unfortunately, we'll have to wait till next week as we get into a new month, and we'll see whether the USDA is going to be friendly on Monday. Until next week, thanks for watching. Don't forget, if you're from Ontario, join our tour. We'd love to have you on board. And remember, next week's a holiday. So Tuesday is a holiday in Canada, and on Friday is a holiday in the U.S. So our next podcast will be next Thursday.
Like you said, Mo, markets are closed on Friday as well. So catch you guys next week, possibly Thursday.
See you later.